Thanks a lot for joining in today with us. We will be discussing about overvaluations because that's the term that's widely used these days in the winter market. And the founders are really keen to know the investor perspective as to why is the situation of down round in existence and how can they overcome that. So before we get into that, I just request the speakers for today to introduce themselves, starting with Shashank.
Hi everyone, and thanks Radhika for inviting me. Super elated to be here and looking forward to the discussion. My name is Shashank Randev. I'm the founder VC at 100x.vc, one of the co-founders at 100x. We started the fund in July of 2019. We are an early stage fund investing through iSafe notes, and we've done 80 investments so far. And we were initially investing 25 lakhs per company. Now we've increased our check size to 1.25 crores per company and hoping to build out a discovery fund of at least 100 companies or investments per year. So looking at a horizon of 500 plus company portfolio companies by 2024-25. So that's a quick overview about 100x and myself.
Well, thanks a lot, Shashank, for giving us that view. Rohit, if you could introduce about yourself and the fund you're building.
Hey, good evening, everyone. This is Rohit here. I'm the co-founder and director of Cloud9 Group of Hospitals. Been an entrepreneur all my life. Started when I was 18. Went on to build an amazing brand in the healthcare sector. Learned quite a bit of things in this roller coaster of being an entrepreneur. Missed a lot of things in also being able to kind of seek the sort of inputs from, let's say, the private capital market, but have been also, big benefactor of marquee investors, believing in my journey. Little about 7 years back, started my own family fund to kind of invest in, amazing founders and help them through the journey. Last year, decided to kind of up this game and, convert the family fund into a SEBI approved fund. So I am en route to building a $100 million fund. This is an early stage, tech first, focused on 4 sectors: healthcare, fintech, SaaS, and consumer. The idea is to go in pretty early, seed, pre-seed, pre-series A, kind of stay with them through the journey, minimum check size of between 500K to $1 million. Not going to be as bold as Shashank in terms of number of investments. I think we'll be a little more calibrated than that. But the idea is to kind of bring in a lot more relatability and, kind of move the discussion away from just capital as a commodity. So the fund's name is K-Peer, and we're calling it as Capital by Peers. I'm identifying myself as a peer and not as an investor.
All right. Quite a dynamic introduction, I must say, and very excited to, see the performance of your fund. I'm sure you're going to make some good bets. Coming to Shreyansh, you invest quite a lot in biotech, then clean tech, and a lot of other innovative sectors. So why don't you tell us a little bit about Ankur Capital and yourself?
Sure. So hi all. I work with Ankur Capital. We are an early stage venture capital fund that invests in technologies and product innovations that sort of unlock opportunities for the next billion. We've been sort of very unconventional investors. We've been pioneers of agri-tech in India. We've been sort of also looking at sectors like, as Radhika mentioned, around biotech and climate tech and clean tech areas as such. These are areas that we continue to make investments in beyond the traditional sectors that we also invest in. So we look at fintech, SMB tech, construction tech, and other areas as such. We come in very early. We come in from sort of anywhere pre-seed to sort of a Series A check size, close to about $500,000 to about a 1.5 million as first check. We are currently deploying from our second fund and soon close to sort of launching our third fund as well. So yeah.
All right. Good luck with that, the third fund. I'm sure it's going to work wonders for you. But, starting with the first question, how did we even get into this situation of down rounds? How did it all happen? Shashank, if I can ask it to you, because you've been very actively involved in evaluating lots of startups. You've been traveling across geographies in India. I've been looking at your posts. So why don't you tell us about your experience in this sector and why are startups facing this challenge in valuation?
I think, if you step back a moment, it's the function of the ecosystem, right? We are at a stage where I think our companies are going through the next phase of evolution. When I started my career in 2008, back then that I think we saw the first wave of investments funds coming in, and we've seen a bunch of these companies growing. And obviously, with this overhype, you have some numbers going a little off, and maybe companies being hyped at overvalued. But I think this is just a course correction. It happens every 10 to 15 years, depending on which sector or which field you are in. I am not, very alarmed by this. Our take on this is that this is a course correction, which essentially means that you need to build sustainable businesses. You need to kind of build out more proof of concept at our stage rather than getting funded on ideas, right? And similarly, the same concept when you're growing as a company, you continuously kind of build out profitability. So I think it's a course correction for funds as well as entrepreneurs. And I think this is cyclical because in the long term, we are still being able to pull out companies over the last 10, 15 years, which have gone to IPO, right? A lot of people say, no, but that's not, the IPOs have not done very well. It's fine. I think it's a function of the ecosystem. But this is not all gloom and doom, in my opinion. And I think this is just a course correction for better times, which lies ahead, at least for the next 10 years or the decade, which in our opinion is very, very promising.
I hope that history doesn't repeat itself after 10 to 15 years, because you said the cycle continues after that. But yeah, let's wait and watch how the situation continues there. But Rohit, what's your opinion on this? How can the ecosystem come out in a better way?
Radhika, I actually agree on what Shashank just shared. I think just taking a leaf out of what he said. I think this is what is popularly now referred to as a cleanse environment, right? So basically, kind of look at what are the basic principles, what are the basic fundamentals. Going back to the unit level economics. I think these are important. But please remember, I think equity is a long lead item, right? It's not about something that happened yesterday and the course changes tomorrow. While it can happen, majority of the cases are basis of a long lead item. So I think these cycles will come in, and I think the winners will continue to emerge. And I think this is a great time for good founders to come in and build, because I think there is absolute merit for value. Having said that, I think valuation itself is a combination of, this is again a popular reference. It's as much as art, as much as it is science, right? So I think art keeps changing, right? The value of art keeps changing. It's macro environment. It's about how good the artist is. It's about scarcity premium. It's about a lot of those other important factors as well. And if you look at what happened last year and the year before, I think there was a lot of unknowns which came into it, right? And some of us were discussing, and there's again a popular term coming out. It's called as capital tourism. So you would have seen a lot of investors who are not native to that region coming in and actually participating. So what that does is actually kind of pushes the price up when you have, a lot of people vying for the same piece of pie. I think those have moved away, and that's how you see a little bit of, sanity coming back in. But again, look, I don't think one can take a short-term view of any of these things, right? It has to be looked at from a particular time frame of, at least about 7 to 10 years. And even the public markets are not averse to any of this. There's been no stock in the public market across sectors which has continuously appreciated. You would have seen everything dropping and picking back up again, right? And that's the nature of the the kind of asset class we're in.
I love the term capital tourism. Wasn't aware of that, but good to know that after medical tourism, this capital tourism is in existence and it's growing up in large proportions. But Shreyansh, why don't you tell us about how you've been facing it with your portfolio companies, if at all? And if not, what is your view on this, upcoming downturn?
See, I think I couldn't agree more with Rohit and Shashank, particularly on this, right? I think very rightly said, it is a cycle, right? And these cycles sort of continues over time, and the course corrections happen as the markets evolve, right? So you do have a lot of capital pooling in and effectively sort of inflating that value up for the company, right? And as Rohit mentioned, there was capital tourism happening with a lot of companies sort of copy pasting models and effectively sort of thereby getting more capital in place, right? Now, fundamentals do not change at the end of the day. Your models of being able to do economics and ensuring that you're sort of being very capital efficient don't change at the end of the day. So as companies sort of are going forward and doing this and keeping close watch on their fundamentals as such, you don't see a lot of downturns happening, right? So companies that are very strong on being able to deliver on their models and show promise as they go forward. Now the promise may have seen some depth per se, where basically you would have people sort of not going with a 5x promise, but rather open to sort of getting to a 3x promise, right? And achieving those numbers are something that a lot of investors are also appreciating towards the next rounds, right? So it is about how the market has also sort of course corrected itself, with investors now not looking for very unimaginable exponential growth curves, but rather are looking at strong fundamentals, strong teams, strong business models in place before companies go forward. And I think these long lead cycles are something that every investor is aware of, right? So thereby you don't see a lot of downturn happening, at least in the early stages, right? So there is enough capital pools that can and are getting allocated and in the early stages. In late stages, I think it has always been that if the companies are not performing well, you don't see enough capital coming in over time in the next rounds, right? So it is a form factor of how you are able to build a very strong fundamental business, and that's how it is.
So,
while short-term valuation is certainly a function of supply and demand, and also a function of liquidity as well. So, but from talking about the long-term sustainability, how should the startups approach valuation, especially in current environment where the liquidity is a little bit dried up and the supply and demand equation is shifting more in the favor of the investors? So how do you recommend startups? So I'll ask questions from Shreyans from the investor point of view and from Rohit from the entrepreneur point of view. Shreyans, you go.
Sure. I think when a startup is sort of approaching this, right, it's really an art, as Rohit mentioned earlier, right? I think and art changes its value on a yearly basis, and it sort of appreciates depending on the supply and demand of capital coming in, right? So in the case of today's market scenarios, we've seen there is enough capital pool that is available, right? There is you can actually sort of go and tap into different types of capital as well to be able to sort of help you get there, right? Effectively, what we've seen, at least, and we've been very at least frugal in that manner in terms of not overvaluing even at early stages, right? So as a fund, we've worked off deals where the companies were overvalued and fundamentally were not something that we sort of made sense to us, right? When we were investing in them. So we walked off tables where basically the companies were trying to effectively work the way up in terms of how the market was evaluating them. And they fundamentally are now seeing issues in terms of them being able to raise the next rounds of capital, just because the fundamentals were not effectively driving the capital valuation in that manner, right? But given at early stages, I think it is still sort of okay, right? Now it has become much more important because effectively in the over the last 2.5 years, the early stages did get that next round of capital bump up very soon, right? Now in the current scenarios, that capital bump up is not going to happen in close to 6 months time frame. It's going to be a 1.5 years before you get the next round of capital. So you effectively have to be enough frugal in terms of being efficient, in terms of being able to prove your business models, in terms of being able to prove your economics in place to be able to get that next round of capital. And the next round of capital is going to value you effectively depending on your growth and your proof points into the market. And that's what we've seen across with our portfolio as well. And I think that is what is critical, unlike the last 2 years when basically the bump up happened in a very short duration time frame. So even if you did not prove your models effectively, you got a bump up in the valuation. So your early stage investors were happy to sort of giving you that X valuation, right? And that's the reason why you see in the early stages now that the valuation is not being given with respect to what was there 2 years ago. But effectively, if you see over the last 3 years or 4 years ago, I think the markets have come, I wouldn't say have come back to normalcy, but have sort of effectively come back to a stage where they are effectively getting valued to what the markets would value them, right? It's sort of is in a place where, you know, there is while there is enough capital, the next round of capital is something that people are effectively looking at, and that's what is driving up the valuations in those markets and business models.
Oh, thanks. And Rohit, what's your perspective from the view of an entrepreneur for building long-term value sustainability of your startup's valuation?
Yeah, look, I think you know, there are very few guiding principles in a lot of these things, right? I think the best form of capital you can actually raise is the one that the customers give you, right? So as long as you have businesses which are building towards attracting capital from customers, I think a lot of these other things tend to wean away, right? So it's easier said than done. I think it's different for different stages. It has to be a combination sometimes where you have a little bit of capital to kind of go give you that edge. But I think as an entrepreneur, one thing everybody has to remember is, you know, there's a lot of pressure on the founders themselves, right? The ones who raise the money. So it's one thing to have a post facto about a specific valuation that the company raised capital at, but, you know, valuation is always something that you grow into. It's not something for you've done already in the past, right? It's not being valued on a discounted cash flow or anything. It is always on the future value, which means you have to grow into it. So while there are, you know, like we already discussed in terms of, you know, when there is a high tide that, you know, everybody kind of gets lifted up, you know, in the macro environment, and, you know, if you end up raising that sort of capital, and hence you see that, you know, under the pressure that you're in, if that sort of unit level economics doesn't value up to the kind of valuation that you're supposed to grow into, then you will automatically come under that pressure, right? So I think my advice to all entrepreneurs across stages, from early stage to late stage, right, is if you see how the gradual change in behavior happens from the quality of capital which comes in. So typically everything at early stage is more conversation led. Everything after is more information led, right? So it can't just be one way or the other. So I think as long as founders know the path that you can actually stick to and kind of, you know, go back saying that, you know, this is a valuation that you can actually justify through the numbers, through the customers, through the build that you have, I think there's nothing much to worry. And, you know, unfortunately, I think the last couple of years saw a little bit of too much of a tidal wave sort of, you know, lifting everyone up. And, you know, some people made good of it. Some people came under the pressure of it, right? So I can tell you overall, I think everybody is wiser. I don't know if it's anything to do with how many people lost money or made money, but I know everybody's become wiser.
So, so how the investors are valuing the startup? So, what used to happen before the current funding winter, and what has changed now? So, Shashank, you can take this question.
So, if I got that correct, you're asking how are we valuing companies now?
No, how you are valuing before this year? Let's say how you are valuing from before the current funding winter started, and now what has changed now in the value? So, how do you evaluate the startup which was approaching you, say, 12 months back, versus how do you evaluate now?
Sure. So evaluate and value. So we don't value. I've outsourced that to Ankur Capital and Rohit because we pegged it. Because the reason for that was we realized that there are specialists who have significant experience at running very large companies and then running large funds and understanding valuation. We realized that this opportunity was as a discovery fund. So we don't value companies. We peg it to a future round. We give the headache to the Ankur Capitals of the world that you guys figure it out. We guys are just building it out for you guys and figure. So, but I mean, jokes aside, so when we are evaluating, I think what happened was when we started the fund, this was pre-COVID, right? So we did 20 investments, all small ticket sizes across sectors, right? And then the onus was to kind of ensure that they are able to raise the next round, and which is a function of how they're performing with in terms of ability to reach a product market fit, or getting a set of few initial POCs, or some of them having recurring revenue, and now can they increase in the percentage growth month on month, right? All these factors coming in and ensuring how can we move forward? And that changed obviously when COVID happened, right? But what we also realized that some of the businesses got accelerated, like SaaS businesses for the first time really moved up. And when we say accelerated, it's not only because COVID happened, it's just that COVID was the amplifier. And now post-COVID, so to speak, these businesses are really, they've changed habits, right? So India has become a large non-consumption market, or rather converting non-consumption market to consumption markets, right? There's a huge opportunity domestically. So at 100x, where we are positioned at the bottom of the pyramid, we still remain super excited about, all sectors in India. We are a fund which is only investing in India holding companies, and our evaluation criteria is just largely around founding team, understanding if they have complementary skill sets. We are looking at the opportunity within India, while we've invested in companies which are building global products, but we've also invested in SaaS businesses which are largely 70% catering to India as an opportunity bet, right? Which is huge to say, for SaaS businesses being built out of India. So we still remain excited about the opportunities coming out of India, and we're looking at the total opportunity size, business model, their unfair advantage. But at our stage, founding team really matters a lot for us, right? And we are seeing businesses grow. I mean, right after the COVID and during COVID, we've actually had, in our view, the most valued companies in our portfolio being developed, right? And their ability to go to Series A. So those businesses are still happening, right? And the only difference what will happen now is that, some folks will just have to continuously build sustainable businesses. And I think that will be the focus. So our evaluation has not changed. In fact, we've gone a little more aggressive in terms of deploying capital. So we've increased our ticket size now in 2022. And because again, this is very different VC, right? So we are not the growth stage VC. We are, so to speak, at least one or two layers below, right? Seed and pre-seed, right? But at this stage, there's so many problems to be solved and so many businesses to be built out. There's no greater opportunity. I think the valuation, when we talk about the layoffs and all these other aspects and angles, if you look at the stage, if you look at the hierarchy, it's all happening post Series A, Series D, E, F, right? But that is also giving a lot of opportunity for pre-Series A to Series A companies to hire experienced people, right? And so there are a lot of positives in this. And as you might be able to sense, I'm very optimistic. We've increased the check size. We are super gung-ho. Evaluation still remains the same. We still look at those 5 tenets, and we're still very gung-ho about the whole opportunity in 2022.
Certainly. So as Rohit said, the best form of capital for any business is the capital they receive from selling to their customers. So, and that's the way the sustainability is. So Ankur, but when you're evaluating most of the early stage startups, they are at the stage where the optimization has not yet happened on the terms of the capital that is being received from the customer. So that's why they need external funding. So when you are doing when you are valuing the startup, let's say anybody else, so what are the criteria you now put in place when evaluating something? Is it based on the one is obviously product market fit, or do you look at any other traction in terms of the revenue sustainability, quality of the revenues of the startup, or any other criteria that we use to ascribe evaluation for them?
See, for us, Divakar, I think we also come in at early stages, right? So fundamental to us also, it is about how we are able to sort of look at market opportunity and effectively sort of be able to get to a stage where we can fundamentally participate in the company as they go forward. So for us, that becomes a very critical factor. And for us, that is a subject of us being able to value accordingly, right? We would like to sort of hold a certain percentage in the company to be able to sort of participate depending on their growth journey and fundamentally be able to put more capital into the company as they're performing well, right? So for us, that becomes one of the key factors for us to sort of get to a particular holding percentage for our kind of capital that is going in. And that sort of is one way for us to be able to sort of drive valuation. But irrespective of that, right, for us, I think even in that case, for us to be able to sort of really look at pinpointing the exact number that we are able to value the company at is actually driven by factors of team, by factors of market opportunity that the company is sort of solving for. the thing that you mentioned about the product market fit may not happen always in our case, right? Because when we come in, there might be companies that are still sort of at a stage where they are just developing their product, right? We've invested in companies in the biotech space, right? There is a company that's in the cultivated meat space that we are investing in at this point in time, right? We are investing in a company that sort of is developing an alternate form of diagnosis that can sort of reduce the diagnostic time by quite a lot, right? So in a lot of these companies, these companies are effectively going to go out there, get their trials in place, get the right systems in place for them to be able to sort of get to the market and raise the next round of capital. So for us, I think what we are valuing is on the potential of the company to be able to sort of go forward and take this to the next level, right? Having said that, we've also sort of been very critical in terms of not being able to overvalue the company, right? Because we understand where the market spaces are and what stage the company is at, right? So by that virtue and by that form factor, we do not want to be in a position where it sort of effectively hits us in the back, given the market conditions are built that way that the next round of capital is going to be about a year and a half away. And unless or until the company is able to prove the right metrics and get to right systems in place, the next round valuer will not effectively value the company in that form, in that number range, right? And if that happens, it is actually unfortunately the problem lies with the founders, right? Effectively, because if it is a down round, there's anti-dilution clause, which effectively protects the founder or investors, but ultimately impacts the founders, right? So it is of no interest for us to sort of actually overvalue the company and thereby sort of affect the founders going forward, right? So for us, we keep that in mind when we also sort of look at rightly valuing the company. We also look at market comparables fundamentally for us to be able to drive to the valuation, right? And we look at and when we make this investment, we actually have a very strong internal process that is set up in place where we go deep on each and every company in the competitive landscape, right? And effectively be able to sort of come to the right number to be able to sort of help rightly value the company and effectively sort of peg it against where the company is at this stage and what kind of milestones they look forward to getting into the next level. So for us, these become very critical as we are trying to get to the right valuation.
Sure. And Rohit, staying with the valuation now from the founder side of things, what the steps do they need to take to justify, or what steps do they need to take, or what are the things they need to point out in order to justify their valuations when negotiating with investors, especially in the current environment?
Look, I think, again, it just goes back to basic principles, right? I think on what are the unit level economics. I think as long as people can continue to deliver on being able to show sustained growth, right? There will be macro environment issues again, where, you can actually experience serious tailwinds like what happened over the last 2 years with a lot of sectors getting amazing digital adoption of a lot of things, right? It worked from SaaS to consumer to edtech to fintech to everything, right? So how do you kind of capitalize, use that sort of well-capitalized consumerism to kind of lift your user base up, right? Some of those things actually matter quite a bit. But in general, I think for founders, is to probably kind of stay realistic in their approach as well in terms, how they have to look at valuation. And like I said before, it's a lot of pressure on the founder, and you don't want undue pressure. A lot of people don't realize this, but the minute you raise capital, there's a lot of sort of don't want to use the word pressure again, but there's a lot of kind of weight added onto you. It's the same thing as pressure, but you have to still go deliver those results, right? So I think being able to kind of build for specific milestones rather than milestones of capital raise, I think should be the most important thing, right? A lot of people actually have looked to sort of build from the meat is running to the reserve, so we need to go and fill up, right? So those again become, these start falling into the whole art category, right? And art is in no one's control. So I think the one which is in the founder's control is the science part of it, to kind of go and build. And if you look at it from aspirational value of what each one founder is building, there will always be good yardsticks, be it in the public market, be it in some parallel industries, be it in some other global industries, global markets. You will always have inferences to kind of deal with in terms of, the total addressable market, the kind of price earning ratio that you have to, what's the burn rate to the customer acquisition price to, there'll be many of these metrics that you can actually build towards, right? So you're never in isolation that way. It's only about making sure that these fundamentals can be, built upon, right? So execution becomes the key.
Right. So as long as you set realistic targets and deliver on those targets, the valuation will automatically get taken care of in most of the time in that way. So,
talking about the founder qualities, because that is what matters. Secondly, like Shashank mentioned, that they bet big on founders more than the companies or the businesses that they are into, since they deal into early stages. So, Shashank, starting with you only, what are the 4-5 points that you look at in a founder before investing into them?
Sure. So, the stage we are coming in at, I think ideas keep iterating and keep pivoting. So a lot of these businesses, and we have many such examples of large scale businesses which started out and in their early years did at least 2-3 pivots before they found their product market fit. So when we say that we want to pay importance to the founders, it's because we want to back those founders who have the ability, for lack of a better word, when everything hits the roof, they have the ability to pull up their sleeves and experiment rather than shut down the company. And that's a very important trait which we try and gauge through our experience, through our collective discussions, consensus, to come upon that. That one trait is very important. So that is part of the complementary skill sets which we look at. And we have, I'm glad to say that at least 4 to 7 companies in our existing portfolio are doing something very, very different right now. When we had funded them, they were completely different. So it's the founders' ability to kind of just walk into the pandemic and walk out with a new business model and ability to raise capital. That I think is one validation of why we do this. So this is one. The other thing is, obviously we look at certain basic structural things. Founders need to be full-time. They shouldn't be moonlighting. They shouldn't be running separate businesses. I think is one of the most important criterias. And I think one important thing of running venture capital, I think, is also the mindset. Are they trying to build a lifestyle business, or they are trying to build a venture backable business? And there's a difference, right? There's nothing fundamentally wrong with running lifestyle businesses because you're doing it at your own pace. But one more thing which we try and understand is, are the founders really wanting to build high scale growth businesses, despite the fact they are already operating in large market opportunities, market areas? Because that is important, because once you fund them, their ability to walk on the treadmill, to continuously absorb large capital and then continue to build is very, very important. And I think this is something which we realize when we work with co-investors or follow-on investors who also want to see, like, if you are, and we've so many times we've thrown questions at founders, do you think you'll grow at 50% if month on month? And they're like, no, we can't. I was thinking of growing at 5%, right? That's why I'm raising the money. There's nothing wrong in that mindset, but there's a way where the business needs to grow, and 50% or a 5% growth is subjective again, right? Could be a function of getting customers, it could be revenue, whatever is creating product validation, right? So all these things fall, as an important criteria for valuation for founders. But at the end of the day, we are trying to gauge at the bottom line is that if the business fails, can they continue to identify a large enough opportunity and make small pivots or large pivots? And I think that plays a major role in at least our kind of fund. And these are some of the things which we look at.
Got it. I mean, I think at the end of the day, it also matters, are you living a life of success or significance? If you're living a life of significance, then all these metrics would matter to you, like 50% growth, not 5% growth. But if it's just success, you will only chase money and not the value creation you bring out of it, not just to your business, but the investors as well. That being said, Shreyansh, how is it that you look at founders at Ankur Capital? I know it's very research-based, investing that you guys do, because it's all about innovation. So how do you stay patient with the success of it?
Oh, we are very, very founder driven. I think they are the fundamental to everything that we do, irrespective of whatever research we do at the end of the day, right? So for us, the founders form a very critical part of of our evaluation process. I think if I were to sort of rate it, it would be probably the first thing that we would look at before we sort of even go deep into the company, right? So, and it is that skill set, right, that they bring on the table. It's the complementarity of them being able to do different kinds of roles, right, and take up different kinds of roles as the company moves forward, right, is going to be critical for us, right? And as we look at these innovative businesses, we're looking at people coming from very different backgrounds as well, who effectively are sort of have some sense of the business, right, or have some sense of the markets in areas that they've worked in, right? For example, the very first company that we had actually invested in is a company called Cropin, and both the founders actually had not come from any agri background, right? But their family was associated with agri in some forms and factors in their previous lives, and both the founders did not have a technical understanding of how agri worked, right? But they went on the ground. They were sort of so resourceful to be able to really understand the problems faced by farmers, right? And I think that is what sort of makes a founder really differentiated, right? A founder who can actually understand, at least in my belief, is that who understands the problem very well can actually identify various solutions to different things, right? I think being able to sort of nail the clear areas and gaps that need to be solved and why they need to be solved can be the differentiating factors between different founders who are doing different businesses, right? So for us, that's how that's one of the things that we sort of fundamentally look at when we are looking at founders. We also look at what kind of skills that they would want to bring on the table, right? What kind of aspirations do they have about the business going forward, right? As Shank rightly mentioned, in terms of them looking at a venture investable business, are they looking at that kind of scale and growth that us as a VC would look at, right, potentially? And that's what is very critical for us, because we are looking at outsized returns. We don't want normalized returns at all, right? So for us, that kind of founders, that kind of aspirations is critical when we make investments. We are fundamentally looking to back those founders who are looking to sort of really throw the ball out of the park when they are doing their businesses.
It's very interesting to know, actually, because it's just like you don't need a degree to succeed in life. I mean, even if you have the right skills and the knowledge, you can still get ahead. So good to know that. But Rohit, with your new fund, how are you going to evaluate founders? What will you be looking at? Very excited to know.
Oh, look, it's actually more of the same in terms of what these guys just spoke about. I think you just can't take away the X factor that the founders bring in, right? I think it absolutely is the same. And like I mentioned before, I think it depends on the stage, right? While the X factor component weighs significantly at an early stage, and hence I told you that a lot of the investments at early stage are probably conversation-led than information-led. It slowly starts drifting into the information-led criteria as you keep growing the company. But I think what is very important is the kind of skill sets that the founder possess. Look, I'm not from healthcare either, right? But was able to build a very large business myself. So the thing is, I think, like again, we discussed just a little bit before, and Shansh actually mentioned this, that I think the clarity of thought is going to be extremely important in what the founders actually showcase. Another couple of things that we look at is the kind of hustle nature that they have. There is no way to kind of say that if you do this, you're great at hustling. It can only be demonstrated either in going back to your past in terms of how you were during your previous work days or in your college days or what, right? I think anyone being able to successfully demonstrate that, I think the last couple of years, especially during the pandemic, have shown that people who can hustle can actually thrive and survive, right? So I think that is very important. And the other thing that we try to determine, again, there's no playbook for this, but we like to call it as the founder market fit. Basically, to kind of understand that while they may be from different markets, what is the right to win for such founders, right? So just trying to kind of narrate out what are those qualities that can actually get them there. It's not about having a specific skill set. If there is, it's great. So between, let's say, a founder to a group of founders, we're trying to find complementary skill sets of how each one kind of marries into the other in terms of how they can complete the product or service that they're building. If they're not, how much of it is a hireable service versus how much of it has to be a core function of a founding team, right? So some of these things actually come into play. And overall, again, look, there are many things which can be put in paper to say that aisa hai karna hai, that this is what we need to do, or this is how we need to go. But you'll continuously keep getting surprised, right? And that's the beauty of this equity sort of business that you go into, right? You go in assuming one thing, and it quite often than not surprises you and becomes a lot more. And typically you can put it down to the founders.
So let's say if the founder meets the criteria specified by all three of you, namely clarity of purpose, product market fit, the determination, ability to manage the show. Let's say they meet all of those criteria, then such founders shouldn't be worried about raising capital regardless of the environment. But if we still see some of them raising questions, asking to themselves, their team, or sometimes their investors, is this the right environment? Should we raise the capital now, or should we wait out? So what would be what's your take on those? Shashank, you can start off with this.
Sorry, I was on mute. So founders asking that, what should they do? I would categorize them in terms of, first-time founders who are raising checks. If they are building a business and there is a market and there's somebody to buy and they've done their product market fit, and that's reached a validation, then they should come to 100x, and we'll be more than happy to kind of accelerate that journey, because you're then essentially still able to create a product which is being sold, consumed in a market, irrespective of the year. And if that is happening, you're automatically filling up some metrics, whichever metric that is, for the follow-on investor to come in. And I think there's enough capital in India right now to kind of, from a seed to Series A, in founders should not worry, is my view on this right now. I think what is happening is, larger private equity funds or Series B onward transactions those are different businesses. As Rohit mentioned, and he very rightly pointed out, that initial, and I would go on so far to say even up to Series A, it's more conversation, right? Information starts increasing, and everything is pegged to that information. And if you are in that stage, then yes, you should be asking the right set of questions in terms of the information you're providing to those kind of investors who are only evaluating on the current business, and not so much at that point of time with the founders, because there are many other co-investors, other entities playing into that model. But if you're in this phase of pre-seed to Series A, there's just so much to be done, right? So founders at this stage should not be asking, and that's the message I'm trying to give out also. And this is what we've been conversing, that it's a great year nonetheless to build out businesses. There are funds like Ankur Capital. Rohit is here right now. There, he's setting up his own fund. He's deploying. Everyone is willing to invest in company, right? If for each one of us, if you meet those investment criteria, we're sitting on capital to be deployed. We are evaluating businesses. We've not shut shop. And if you are building a business which has a product which is being consumed, there's nothing to worry. You are meeting the criteria, right? So I think the notion is a little misplaced in terms of late stage companies and displacement of employees from there, as opposed to what is happening at least at the middle of the pyramid and downwards, right? There's enough work to be done. So there's enough capital to be raised. I think founders should continue building.
So it's more of the funding for the Series B onwards, the mid to late stage companies, where, as you mentioned, information, the evaluation is based on the information rather than the achievements done by the company thus far, rather than the founders themselves. Which is probably why some of the marquee VCs from overseas, like Y Combinator, even Sequoia, sent out memos to their companies to conserve capital, because they fear, because the Series B onward investors are a little bit more picky and choosy on that. So Shreya, do you think that is the thinking going on in the market?
I think for us, it is rightly right. I mean, at the end of the day, we have to do our job. Our job is to deploy capital, get returns on these companies, right? So for us, right, it is very important. We can't be sitting on the capital and sort of stay put, right, at the end of the day. But having said that, yes, I think any company and any founder who is sort of building a good business, right, has things that you rightly mentioned in terms of getting the right team in place, getting the right market conditions in place, in terms of being able to get some business in proposition, right? And effectively sort of also seeing some level of a product market fit, right? I mean, I don't think a product market fit is an easy way out. I think it's a very, very difficult journey. I've seen companies even at Series B or C haven't been able to get to a product market fit while they've got very good revenues, right? It's just that I think in terms of what is defined as a product market fit for you in your market segment is going to be different and critical. And I think we have not been very we're not going to be shying away from those, right? We are going to continue to sort of make investments in such companies as well that are riskier, right? Because at the end of the day, as a VC, we are in an asset class that is going to invest in a much more riskier segment of the business, right? A PE can take a less risky, more, driven business that has sort of a linear growth stage or somewhere around that, right? But for us, we are in a market space where we are going to make those risky bets. There is going to be successes and failures in that, right? So we are going to continue to make those investments depending on how the companies are getting formed and what kind of problems they're solving. I think those fundamentals won't change for us, and we continue to deploy capital.
So since you also probably also participate in the further rounds of funding of your initial round companies, so do you see in this further series like Series B, Series C, is liquidity also playing an impact when these companies are going for the market to raise further round of funding?
And you mean liquidity for us as funds to be able to sort of get exits, or do you mean liquidity?
No, for the founders to get further round of the capital into the company.
I think there is enough capital pools, right? I think as I said earlier, if you are building a strong business, right, with right fundamentals, economics, and metrics in place, there is enough capital that is looking to back you up, right? A lot of our companies are in stages where they are potentially looking to raise next rounds of capital, right? It's just that I think how you look at market conditions, what are the key propositions that you are looking to solve for, and what is the key with which you as a company are going out in the market is going to be differentiated, and that's what is going to take calls for you to be able to sort of make that sense in the market, right? So I think we have seen a lot of investor interest continuing to be in companies that we have invested in later stages and continue to sort of back those companies up. There is liquidity available in the next rounds of capital. It's just that I think it is being more effectively chosen, right, rather than being more driven by market conditions. So there is enough from
the FOMO effect is wearing off in the later round, I guess.
I actually have an interesting question for Rohit. How was it while raising money for Cloud9, especially after Series B and C?
Well, I always keep telling founders whoever I can meet with, right, that I only build network through relatability. We started the business in 2008, and for those who can't dial as far back, this was like probably the worst time to start a business, right? This was a subprime crisis that the US had gifted to all over the world. Capital markets were in a tizzy. You can't have chosen like a worse time to build. So I think as humans, adversity brings out the bestness, right? So I'll come to your question, but just wanted to add to what Shashank and Shreyansh actually mentioned, that I think founders will always find that, there are two qualities. There is one which is based on lag indicators, like something which happened in the past and hence unlocked some potential for somebody to build, like what happened with COVID. You saw a lot of gaps in distribution. You saw a lot of gaps in terms of, actual, consumerism, asking for things which were not there. So a lot of people built towards it. We will also have a lot of people building for lead indicators. So for example, in health tech, there is the National Health Stack, which is, soon to be around. There is the, NDHP, which is the digital health blueprint, which has been around for a while. You will see that there are a lot of such entrepreneurs knowing what's coming to build for that, right? So you will always have, irrespective of what's happening around, you will have this sort of, founders who are building for both lead as well as lag, right? So I think this, just to put it out there, I think it's a great time to build, right? So again, take it from me. There's never not a good time to build if the idea is strong. To your question, Radhika, how difficult was it? Well, it's always difficult. It's never easy. I don't think anyone will find it easy that there's a incoming request of, so much of capital which will happen. I don't think that ever happens. I mean, it does happen in parts, but not as one thinks. But I think it's about showcasing what is out there. Like I told you, valuation is something everybody grows into. So what can that capital get you from the point that you raise that money to where can you go, right? So I think as long as for us it was, I'll tell you the simplicity for us was to kind of get into cookie cutter mode, right? About how much of replicability can we do. We're still in the brick and mortar kind of business where, you know, we have to put up physical infrastructure. There is a gestation period. There is a time during which operations will happen. There is a lot of investment to build up the bench and the training and, you know, the service orientation. So for us was to get it into a cookie cutter mode where, you know, you're continuously evaluating how you can actually bring capex down, how we can actually bring opex down. So when we started hitting our stride, some of those things became a little more relatable, again, to use that word cautiously, from an investment point of view, to say that, you know, if I do this and here's where the capital is going to go, here's how the growth is going to come, right? So that changes. And hence, again, going back to that, at the cost of repeating again, is, you know, from conversation led to information led. So I think that's the only easy part, but really nothing is easy.
I agree. This is the highlight of the session, conversation led and not information led in early stages, and vice versa in the late stage. So, yeah, thanks for bringing that about. But lastly, to sum it up, there's a lot of talking going around the edtech sector that startups are anyways valued higher there at higher multiples, and the revenue recognition practices there are not so good. So, just a last few points, if you all could give in, starting from Rohit yourself.
Okay, I'm a novice in edtech investments. All the ones I had exited during the pandemic, so I'm a happy customer there. But to tell you the truth, I think, listen, if I remember right, I think last year sometime is when in the US Coursera listed. And from then to now, if you look at it, the range of drops that have happened, even in a fairly developed market like the US, it ranges from 17 to about 84% on public markets, right? So it's but natural to expect something like that in the private markets as well. The overvaluation or something is, I think, like I told you, it's a little bit of things to do with capital tourism. It's a little bit of scarcity premium. It's also because I think of the macro here again, given the number of people who are actually clued into an online sort of education system, right? As things started cooling down, you see that a lot of people have drifted away from online to offline, right? So you see that sort of coming in now, and hence a lot of online guys also trying to capture that imagination on an offline piece. But I think if you look at it, the metrics were always great in terms of propensity to pay, in terms of average order value or average ticket size, to the longevity of the customer. You're right. I think there's a little bit of amortization which has to be, dealt into in terms of how they recognize revenue. But those are more semantics, right? But I think the general value proposition was there. The cohorts developed. Things started becoming more vertical than horizontal. So I think there was a very good run. So, but unfortunately, it just became a capital game rather than a value game, right? And hence you see a lot of people getting caught out on that.
Yeah, that's true. Shashank, what's your view on that?
Sorry, again on mute. Well, we've invested in edtech companies in our portfolio. They have gone ahead and raised capital. There are newer models, as I say, as we've been witnessing in edtech, is that some of them which are working towards community-based platforms or community models, right? Those are evolving. We invested in a company called Blue Learn, which got funded by Lightspeed, right? And this is all happening in COVID, right? Just to build on Rohit's point, I think, and to add to yours, Radhika, is that edtech, traditionally what we are referring to is possibly not what edtech is going to be for the next 10 years, right? So, and maybe not we peg it to the larger established edtech players, but I think there's a layer of edtech play which is happening, which is on the preschool, higher education, and university level, with again multiple policies coming from the government side, but also newer models emerging which are not directly falling under edtech. There could be Web3, community-based platform. There's a fintech play coming in some of them, right? So as I said, the sectors are evolving in themselves. So the question is edtech going down? In my opinion, no, because it's evolving into branch field. So I can now look at one piece of edtech and invest in that also, right? And I think that is what is happening in the ecosystem. Hence, If somebody said, I want to build another Byju's, obviously, yes, we'd be like not going ahead and investing in them. And maybe eventually miss out on the big one also. But I think there are various models which are happening. And edtech in its standard form is evolving. I think those models might not be applicable, the older ones. But either way, something has happened in edtech. Right? Edtech has fundamentally transformed over the last 5 years, right? Pre-COVID also, right? So hence layer one has been established and we're building on layer two. So there's going to be rebranding of sectors or newer verticals emerging, but either way, it's all here to stay. And we, as an ecosystem, India is a great market from all aspects. So adding to Shreyans's point, agri-tech, huge opportunity. B2B technology, SaaS company, huge opportunity. Fintech and healthcare, as Rohit mentioned, healthcare is evolving on a different level altogether. You're going to see a lot of horizontal and vertical plays coming in healthcare, which you possibly would not have seen anywhere in the world. That's the amount of progress which we can see. And fintech obviously has been doing the round with thanks to the UPI, right? I don't think so. India has, or any country in the whole world has seen vertical horizontal play of fintech seamlessly coming in thanks to just one UPI, right? So either way, edtech or any other sector, great year 2022. If we keep continuing to building, there's enough capital. We just need to kind of continue to ensure that profitability slowly and steadily kicks in, and frugality is somehow maintained also while you're building it and keeping that in mind. So that's my thought.
So I agree to your point where you said that edtech has different forms and ways of evolution. I mean, today a YouTube channel giving out courses is also known as an edtech platform. I mean, Physics Wala is the best example of it. Building a YouTube channel and an app from that, and then becoming a unicorn is in itself,
You should ask Shreyans a question, because they recently backed a very interesting company in the edtech space, and you should understand their thesis on that, because I remember speaking with them.
Why don't you tell us about it?
So we actually invested in during COVID times, right? So for us, we have not seen the light of the day as Rohit has seen in his side. We still yet to sort of get to that stage, but I think what Shashank mentioned, right? I think edtech has evolved. There was very different evolutions of edtech that happened in different time scales, right? There's an education 1.0 to effectively probably a 3.0 or a 4.0 that we're living right now, right? Where basically you have different layers that are coming in, right? In terms of being able to sort of target the segments, break that segments into different forms and factors, and approach through a new methodologies, right? We've invested in we've invested in a company called Josh Talks, right? They're very two different, starkly different types of companies targeting similar age demographics, right? Possibly, but they're targeting very different kind of people, right? They're targeting segment on one side, they're targeting a segment where you're looking at alternate career options, right? So you have huge number of people who go into university courses but don't really end up pursuing that as their career options. So you're trying to sort of upskill them, get them the right courses, then effectively get them the right jobs in those alternate areas that they are interested in, right? So you're sort of effectively finding the ranchos of the world in some factor and formats, right? On the other side, you have Josh Talks that sort of is inspiring people using YouTube as a platform, right? Like Physics Wala, which is very specific, focused on physics and effectively eventually into other segments probably, right? Josh Talks is sort of looking at how do you sort of create hyper-local, very micro influencers, right? Who are inspirating leaders, getting those inspiration leaders to effectively then start being able to sort of put content and skilling courses around them, right? So you're looking at everyone across segments, right? From your local security guard to even a person who is next door neighbor to you, who are looking at these local influencers, getting inspiration from them, and effectively sort of getting the right tools that can help them get to achieving those dynamics that your particular ideal has been able to sort of achieve, right? So you're sort of setting up benchmarks for yourself and then going forward. But having said that, for us, we still get to see how valuations will turn out for edtech, right? Other segments that we've invested in are very different from the areas that are sort of probably seeing some level of downturns, because you have people going back to schools, going back to colleges. So there is a segment of people that's transitioning back from the last 2 years of completely online to an offline system. There is sort of a segment where basically people are completely going, hacking both ways of looking at offline plus online. Some segments are sort of completely averse to online now and going completely offline. So you have very different kind of customer base and demographics that sort of behaving very differently. So it's yet to sort of start seeing that light of the day, and education as a market itself is long-term driven, right? You can't have outcomes associated in a 1-year time frame. You will have to sort of wait and see how those effectively turn out, right? Specifically in the K to sort of university segment, right? The segments that effectively the ones that we've invested in are very specific, people-driven, right? So it's not sort of very course-driven or educational, design framework-driven per se. They're sort of more motivations of people to be able to sort of drive themselves in a particular side. But having said that, I think the valuations are seeing very crazy levels. You've seen the likes of PhysicsWala becoming a unicorn with no capital raise, completely bootstrapped, with amazing low CAC numbers, high lifetime value customers, right? And I think at the end of the day, going backwards, right, it sort of all really depends on your fundamentals and metrics, right? It is that will drive valuation, irrespective of sector. So at least I believe in that, and I think a lot of companies which are sort of solving for those in that manner are able to sort of get that in place.
Good.
So
And
we
picking
are,
up,
yeah,
picking
so
up
we have
from
actually,
what you said.
we have a question from the audience. So
Okay.
one of the questions from the audience, and this is towards Prashant. So how much do you think the first time founders should, when they are raising their first check, how much should they dilute?
See, we have a standard check size at our end. We are doing 1.25 crores for a future of 15% equity, which means that they don't go through a dilution round right now. Either way, if they raise, we believe that they should not spend enough or more time on valuing their company in the early stages, particularly in the first round. The first 2 rounds should be through a convertible note. We've made our instrument open source, which is iSafe, which is on our website. So many founders have raised through that, and we've not funded them, right? So our message to the founders is that irrespective of who you raise it from, our terms are very standard. They're on our website. Everybody knows it. But the point which is to be remembered is that when you're raising capital, private capital, our recommendation to the founders in the Indian ecosystem is don't value yourself, don't do an SHA round in the first 2 rounds. At least build up and create that value, right? And then possibly do a shareholders round at a pre-series A, or series A in between that. That is an ideal time, at least the way Indian ecosystem is right now, because you can't possibly build, say, I have a deep tech product, but I don't have any clients. It is working. There's a proof of concept, but I think I'm valued at 5 million. Doesn't make any sense, right? You can't, okay, I'll negotiate, I'll say 2.5 million. Doesn't work. I think you need capital to build out, focus on that. There are multiple avenues of raising capital without diluting upfront. Build, scale, raise another round, build, scale, raise another round, and then the valuation discussion comes. And that's our message to the founders at the bottom of the pyramid, so to speak, the first check kind of community.
And Shreyans, what's your recommendation to the founders when they are raising their first round of capital?
I think I would echo what Shashank said, right? While we are an investor that sort of has is coming in with a pure play equity, right? So we would like to sort of hold to a certain percentage, but I would not want the company to also dilute a huge number in the early stages, because it sort of effectively leads to more dilution in the next round. And effectively, as you are going forward in the further rounds, because you will get diluted, you need to have certain holding into yourself to help you sort of grow, right? So I think from that perspective, we've been sort of averaging close to about a 12 to 15% in the holding that we've been sort of investing in. But anywhere close to about a 10 to 20% is something that almost any other investor would look at this point in time, from what I understand.
Sure, that's very helpful. Radhika?
So yeah, actually, I was saying that Shreyansh, picking up from what you mentioned on Josh, I'm sure that our audience also picked up a lot of Josh from all of your views. So thanks a lot, Shashank, Rohit, and Shreyansh for joining in today, giving our time and such valuable inputs. I'm sure it's gonna work out really well for the founders, especially after you said that there is enough capital available for the early stage founders, and our audience was more so on that front. So indeed, it was a very motivating session for them. But yeah, thanks a lot again, and hopefully we'll meet our paths again in some future webinars.
Thank you. Thanks a lot, Radhika.
Thank you, Shashank. Thanks, Rohit. Thanks, Priyank.
Thanks,
Thank
guys.
you.
Thank you guys. Bye bye.
Yes, guys. Bye.